so I invested. I started to look into stock, and I really focused and studied it. And in fact, the first book I actually ever studied on investing is this book called The Intelligent Investor by Benjamin Graham. If all of you have, if some of you might have known Benjamin Graham is the father of value investing. He is also the teacher for Warren Buffett. After I studied this book, I go on to study The Secret of Millionaire Investors, I studied security analysis, and I studied Japanese candlesticks. I studied about Fibonacci, technical analysis. After studying everything all this, I thought I am the financial genius. But ended up, what I really is, I was really confused. Have you gone through a subject when the more you study, the more confused you get? Because one author will tell you do this, and the other author tell you do other things. Then who is right? And I was really confused. So I stepped back and looked, what are the few things that I really need to know to invest profitably and safely and do not require so much of my time? And I figured out the 3 pillars of investing. And this is exactly what I shared the first time about what to buy. What to buy to achieve a 15 to 20% return on investment every single year. And this is a map of Malaysia, and all of you stay in Malaysia, right? If today I tell you the population growth rate of Malaysia is 8% on average, and being a Malaysian citizen who read newspaper, would you be able to tell me which city will probably get higher than 8% and which city will probably get lower than 8%? Sorry? Penang, you're right. I just briefly give an example. You're right. Georgetown, probably, layman people will know Georgetown will probably have a higher increase in population, right? In Penang. And KL? Yes?
Yes.
Kerteh?
No.
It's true, because it is not a rocket science to choose a city that will have a higher rate of return or higher population growth than the national average. It's similar to choosing a stock, and you can easily choose a stock that makes 15 to 20% better than the market average. So after knowing what to buy, the next question you ask is when to buy. So I listed down this the S&P 500 index. The performance, the S&P 500 is the Standard & Poor's 500 top 500 companies in the United States, and they have a fund performance that manage this performance over the past 20 years. And you can see the share price goes up, comes down, goes up, comes down, goes up. But what we notice for the past 20 years, the market is on the uptrend, right? Yeah, uptrend. So if I tell you, if you buy a stock at this point, and you have to wait 8 years later, only you make this profit, would you be interested? No, right? You want to buy here, right? Yes. Oh, very greedy, And I have shared previously in the second session the 4 indicators how you can buy at around this point in time and make this amount of profit and go off before the market tanks. And that's exactly what I shared in the second session. Now I want to share the third session.
Excuse me?
Yes?
May I know what it has to do with the population growth rate and the investment?
I'm just showing an analogy that you can easily figure out a city as easy as you figure out the stocks to buy. So you know what to buy. Very simple to beat the market average returns, and you can know when to buy right now. Does that answer your question?
Thank you very much.
When to buy. Now the third pillar is the most important one. You know what, you know when. What is the next question?
How much?
The real question is how much to buy.
How would you know when the market stock goes up and goes down?
I can talk to you later because I shared in the second session, which is where's the 4 indicators. Okay. You can talk to me later. I can explain more details. But how much to buy is what we are trying to cover in this particular session. It's called the position sizing. It's called what?
Position sizing.
And position, I want to introduce to you these 3 terminologies. I call it the SARS. The what?
SARS.
You know, Hong Kong, 1997, they have a SARS, right? So remember this, SAR. The S stands for stop loss. And I bring you to this concept called stop loss. You look at Dylan, Dylan have a very smooth face, right? You know, every night, Dylan, what Dylan do? Dylan go and use new skin product. Every night he put on his face, that's why it turns so smooth. And I tracked these shares called New Skin. How many of you have heard of these shares? Yes? New Skin is a MLM company based in US. And these shares have went all the way up. Just assume if Dylan were to be interested at these shares around $125, and Dylan put $125 in. Dylan is a very conservative investor, and he said, the share price goes down by 5 ringgit. I want to get out already. because I don't want to lose too much. So, Dylan, if the share price moves down to $120, Dylan will sell the shares and leave. Alright? The difference between 125 and 120 is $5. And this is what they mean by the stop loss technology. Okay, good? Any question?
We set a target where we lost.
Yes.
When we lose, we want to come out.
Yes. For conservative investors like Dylan.
Yeah.
Okay, so I want to introduce to you another thing. When Dylan buys these shares at $125, of course Dylan must be seeing some prospect in new scheme, right? Let's say Dylan think the shares will go up to 140. Yeah, potential to reach 140. At 125 to 140, how much return? 15 ringgit, 15 US dollar. Is Dylan a good investor? Good what? Because he risking $5 to make a 15 ringgit. It's a 1 to 3 ratio paid out. Is it good?
Yes.
So that is a good bet, right? Anyway, this is just first thing, which is the SARS, stop loss. I haven't come up to. You want to know how much you want to buy, right? The second one is account size, and I can explain and risk per trade. Our account size is how much you want to place into your brokerage account to invest. Let's say you want to place 10,000, and each time you buy a shares, you want to determine if the shares, if you really study and analyze what to buy, you know when to buy, and let's say the first 2 weeks you fail, you swear lah. You just buy and you make a mistake, you will still lose only 2%. The risk per trade, assuming a 2% risk per trade. This is how this number of shares you should buy to limit your loss. So if Dylan come up with a shares new scheme, and his account size is 10,000 US dollar, and the risk that you want to take for buying these shares is 2%, you divide by $5 stop loss, you get 200 divided by 5, and the number of shares is 40, which means the number of shares to minimize the risk is buy 40 shares of new scheme. And if he have 10,000, he can only buy 40 shares of new scheme. Does it make sense?
What's the 2%? I don't understand.
The 2% is the risk per share. If I have $10,000 and I buy these shares on new scheme, and I buy 40 of them, I set the stop loss of $5, which means if new scheme came down by $5, I sold everything, and I would have lost 40 shares times 5, right?
But
Yeah.
why need to multiply 2?
This risk per trade is your own preference. The recommended risk per trade is 1 to 4%. My general statistics are 1 to 4%. So which means if you really make a mistake, the maximum losses that you can make on your 10,000 account is only 2% or 4% or 1%. Some people say at 1.5%, some people say at 2%. So it's based on your risk. So if you want to risk more, you can increase the risk per trade, and you'll figure out your number of shares to increase. Does it make sense?
Yeah, will you be telling us later how to make the 50% to 20% that you stated?
Yes, I'll show you. Yeah. I'll show you. So I did this test. After you know what to buy, when to buy, you do the analysis and you know how much to buy. So I did an analysis, assuming Dylan used 10,000 and he bought 40 shares of new scheme. Then he lost. Second time he bought again, he lost. Third time he bought again, he lost. Fourth time he bought again, he lost. In English, what do we call that?
Lousy.
We call it suay lah. Suay in English means very bad luck. So ladies and gentlemen, it's not my fault. It's not your fault. And it's not Dylan's fault. It's feng shui. Very bad feng shui. But ladies and gentlemen, if he really is such a bad luck, he bought 20 times and he lost 20 times in a row. Based on these statistics, he would have only lost 32% of his capital. Is it possible if you lost 32% of your capital, you can still come back? Yes, sir?
Yeah.
So if there's one advice, go and say Dylan too. You really lost 20%, 20 times in a row. But the fact is, by the way, any question?
I'm just saying, but Lilian too is Lim Kam Tu one. So,
I'm just giving. By the way, this is joke, you know, right? Just now, during the introduction, I heard Daryl was mentioning Chinese New Year. He likes what? Like to gamble. Let's say, Daryl, let me ask Daryl. If Daryl, you have a dice, and you roll a dice, you go to casino one day, you want to roll a dice. You want to buy big or small? If you buy big, what is the percentage of chances that you would actually strike
50%.
the big? Sorry?
50%.
Correct, 50%. 50%, right? When you buy a shares, the share price can go up and can go down. If you buy it to go up, you have how many percentage chance? 50%, right? Over the long run period, is it reasonable to say every one of us here have a 50% chance to make money? Correct? And based on the 2% trade that you enter into, the 2% is risk that you take, 2% of loss. And every time when you enter when your risk and reward ratio is more than 2, right? Just now we calculate 2, right? And you only have 50% chance. -4 is the risk reward 2 ratio, which means you make back 2 times. And you lost 1 time. And based on this ratio over 20 times, I randomly put my gain at a 50% time I make the right choices, and 50% chance I make a 2% loss. And I will get a decent 16% return on investment. Simple math.
Sorry, how does that work? I thought it will still come at 50%. How does it come back? I thought it's all. You still come back to it's a 0 expected value, right?
No.
If it's always half.
Every time when I buy, a share, I have 2 times I have a potential 2 times reward. But every time I buy a share, I limit my loss to 1, which means I limit my loss to 5, but I have a chance to make $10. Right now, at the 50% percentage ratio, which means I only write 50% of the time. I only write 50% of the time. The first 50 of the time I lost, I would lost 50 times $2, right? But the 50% of chance when I make, I make 50 times $4 per annum.
Yep.
So you invest how much? $2.
You invest based on the number of shares you calculated, the number of shares, the position sizing that I mentioned just now.
It's a bit hard to visualize without the. Can you see? I can't really see how does that work.
For positive is the loss, for the
Okay.
negative is the return.
Okay, for the positive is a loss, okay, and both are the equal chance, right?
Yeah.
Statistically, this doesn't.
No, when you gain, right, you gain the maximum.
Because when you buy a share at 125, let's say
Okay,
125.
let's say you invest $100, okay, put it now.
Okay, let's say you invest $100, and you set your stop loss at $95, which means you risk $5 because you think that these shares will go up to 110.
Okay.
So you make $10.
But that depends on if you're thinking that this share have a higher chance of going up to that. That means it's based upon, of course, based upon our assumption about certain.
You only take a trade when the risk and reward ratio is more than 2. Equal or more than 2, which means you are putting $5 to make $10. But let's say you only write 50% of the time.
But even the risk premium is also based upon certain expectation. Okay, we think these shares are maybe Maybank can think of a higher chance of going up than down. But still, it can become a bit like there's always still a risk element involved, which our investment may turn out quite different. Let's say something happened. Let's say like maybe
Let's say
the US dollar suddenly increase a lot of every ringgit. Then this
let's say you bought the shares at $100 and it doesn't go up to 110. It goes down to 95. You lost $5.
You lost 5, yeah.
Yes, you're right. You lost $5.
That's it.
Now the second time, you buy again at $100 in another shares,
Yeah.
and it came down to 95.
Okay.
You sell, you lost. Is it all the time you lost? You won't, right? The next time you buy again, it went up to 110.
So, but some people do lose.
Yeah.
Money or.
But when you roll a dice, you have 50% of chance the share price will go up, 50% of chance the share price will go down over the long run.
Yeah, but if we go to the casino, let's say we roll the dice, we will lose because the house always wins because they have a slightly better chance than.
The reason is because in the casino there is one more figure. What is that? You can buy big, small, and deals, right? They also said the same figure. That's why the casino always win because that is the third element here. But if the element is only big and small, I can tell you the casino will work exactly same chance as you. The reason why the casino will win is because the casino have another column called the 3 numbers is equal. And that's the reason why the casino, the bankers always win. But if you only have big and small, you will always have a 50% chance of winning. Does it make sense?
Yeah, it makes sense, 50%.
Okay. Yeah. So based on this 50%, if you look at this return, I just randomly put, and you can do this calculation at home, you will find out that you will still make a 16% return on investment. Any question?
So in summary, you're actually betting 2 times the amount you will lose. Because if you lose 5, you have a possibility to gain 10. Yeah. So that means you have the opportunity to make the mistake twice. But you win 1 time, you win 2 anyway.
Yes.
So you're hoping on that 50.
And most shares will find out that it is more than 2.
Okay.
in a motivational industry, in a motivational kind of scene, you think it is not how many times you fall down, it's how many times you get back up. And this guy, George Soros, have this saying, it's not whether you are right or wrong that's important, but how much money you make when you're right and how much money you lose when you're wrong. And that's exactly what this principle is about, the position sizing, how you can calculate to make expected 15 to 20% of return per annum consistently. I hope all you enjoy it, and please give all your a round of applause.